This is the Mobile Home Park Lawyer Podcast with Ferd Neiman. If you're looking to generate wealth and passive income in the lucrative world of mobile home parks, you're in the right place. You'll discover solutions to the common legal and operational pitfalls and how to optimize parks to maximize income. Your host is in the trenches. He's a real estate attorney, financial analyst, and mobile home park investor and operator. Now, let's turn it over to Ferd Neiman.
Welcome back, Mobile Home Park Nation. Ferd Neiman here again today with another episode of the Mobile Home Park Lawyer Podcast. Got a great episode today. Today's going to be a unique topic on REITs, Real Estate Investment Trust. I've got an expert in the field. He's an author. He's a thought leader. Knows more about REITs than anybody else we've had on the show, and maybe anybody out there. So really excited to have him as a guest today. Please help me welcome Brad Thomas. Brad, thanks for coming on the show, man.
Great to see you, Ferd. We look forward to it, man. I've heard a lot about you, and this is a great podcast. Thanks for letting me on.
You got it. Well, like I said before, I follow you on LinkedIn, and you got a lot of good content. And you're the only guy I know who I think has a recommendation from Sam Zell on his book. So I'm pretty jealous about that. I don't have a book, but if I do, I'm gonna have maybe ask you to read it, and then maybe we can get Sam in there too. But that's awesome. So tell us a little more about yourself, your background, and then we'll get into REITs and get into some manufactured housing REITs and stuff as well.
Great. I'll just keep it really short. I've been in real estate now for about 35 years. Right out of college, went to work as a leasing agent. Then I pivoted to become a developer, saw those developers making money. I wanted to collect my own rent checks. Did that for about 25 years, and then also operated a couple franchises for Papa John's and Athlete's Foot. Then this thing came along called the Great Recession. If you ever heard of that, it's the great one. And I did a pivot. I did a complete pivot, and I went over to become a writer, an analyst. Never really liked writing, and actually made C's in college in English. Full disclosure. I did write the rap review in high school. That was the old school rap, of course, Ferd. But then I always loved writing. I like communicating with people, just like we're communicating here. And really helping individual investors with real estate decisions. I lost a lot of money in my past. A lot of that was due to some lack of liquidity when I needed it, not being diversified. And really quality management. And that points all directions to REITs, because REITs have liquidity, REITs are diversified, REITs have the transparency of publicly traded. So it was a great pivot for me. I've been doing this new job for about 11 years, and it's been a really exciting business. So I love educating investors and helping them build their portfolios with publicly traded REITs.
Good stuff, Brad. Now, I'm familiar with REITs. I used to work with some guys that had a publicly traded REIT and kind of entertainment business and some other real estate related entertainment. But you obviously look at a lot of different REITs. Can you just give us the Reader's Digest summary of what's a REIT? Because people are like, should I divorce? I can invest in real estate. Well, that oftentimes is like it's a limited partner in a syndication. It's oftentimes is an active operator, which has its own pros and cons. But a REIT is clearly going to be a big operator, generally a professional operator, a publicly traded company. How do people invest in REITs, and what are the key distinctions between that compared to others, say dividend investing, stock investing, or active real estate investing?
Sure. Well, you mentioned it. I just published a new book called The Intelligent REIT Investor Guide. I'm actually going out with a master class here in a couple of weeks, which will be part of that book. But in that book, and I encourage everybody to read it because we do cover all the details. But at a high level, there's one law that really differentiates REITs from any other type of investable asset class. And that is that REITs are required to pay out 90% of their taxable income. This law was created in 1960, actually part of the Cigar Act in the Eisenhower administration. And what that did, that law, that really premise for that law was it gave individual investors, and I'll say that again, individual investors, not institutional investors. So this is average Joe and average Jane, gave them access to institutionally held commercial real estate. Now, when it started out in the very early days, they were just very limited. There were just a few REITs. Actually, a large majority of these were mortgage REITs. They lent, they didn't own the property. And then they evolved into more equity REITs, which they own the property. And of course, in the very early days, in the 70s and 80s, the REITs were just the primary food groups like retail and apartments. And now these days, when you kind of fast forward from 1960 now, over 60 years till today, is what's really amazing is the size, the depth, the diversification, the liquidity in the U.S. REIT sector, even sectors that I never imagined, even when, 10 years ago, when I started writing, I never imagined that I would be covering cannabis and prisons and cell towers and data centers. So we've seen all types of new real estate assets. Again, part of that law is they, of course, have to be real estate. The companies have to own or lease real estate. I want to clear that up too, because you don't actually have to be a REIT to own the property. You can lease it. A number of these cell tower REITs, for example, they don't actually own the land. They own the easements or the dirt underneath it. They control that through a lease. Same thing for data centers. Those data centers a lot of those companies like Equinix, they don't actually own the physical building, but they did get the IRS private letter ruling allowing the racking system to qualify, because it is attached to the ground, right, to qualify as real estate. So that's expanded that envelope. So it's a very large, I think about it like this, and I talk about it like this a lot, is that think about, one day we'll probably have NFL or NBA stadiums or railroads. There's a number of things that could be readable. So it's an ever expanding universe. And that's one thing I like about the business, because it does give individual investors all types of options and alternatives to invest in real estate.
No, good stuff. That was always an attraction of it. Like you can buy a share of Coca-Cola, right? You don't have to own Coca-Cola. You can buy a share of an NFL stadium or some data center as a REIT. Now, in general, because there's a large regulatory environment, I know, and these are big scale projects, big scale companies. What is the range of yield or investment return? I mean, I think of REITs oftentimes as more because they pay out the cash. It's kind of like a dividend, but because there's real estate, there's some other benefits, hopefully appreciation and NOI growth and things like that. How does that work for an individual investor like myself? And do any of the tax benefits from real estate come to me, or is that all at more the corporate level and they don't flow through? And what are some of the pros and cons of that?
Yeah, great question. Well, again, what really drives this REIT sector today, and I'm talking for the retail investor, individual investor, is dividend yield. And again, so when you compare the REIT dividend to, say, the S&P 500 or S&P stocks, or say traditional like dividend kings or dividend aristocrats that are not REITs, those yields are somewhere, sub 2, maybe 1.5%, say on average, whereas the average yield across, for all REITs is somewhere in the 3.5 range. So really almost more than double the average dividend yield. And again, it's obvious what drives that higher yield is, again, going back to that law from 1960, the REITs must pay out 90% of their taxable income. So there's not a matter of, will they have to, or they can't become a REIT. They have to pay out at least 90%. And most pay out, by the way, 100% of the taxable income. Now, one of the things we look for in our research, of course, is we want investors to not only invest because of the yield, because a lot of investors, not just REIT investors, just stock investors in general, they always look to that yield first, but you've got to look to yield safety. How safe is that dividend? So we look at things to make sure that the company can cover its earnings, which we have a little different metric in the REIT sector called FFO, funds from operations, which basically factors in the depreciation, because REITs do have real estate. So when you add back that depreciation, you really come back with a more a pure form of earnings, which is a better form of earnings. So I coach or tell investors all the time, you shouldn't compare, REITs on a price to earnings multiple. You should compare it on a price to funds from operation multiple. That's one big difference that we see all the time. But again, in terms of kind of that comparison, it's a lot of it's yield. And we like to see dividend growth, because companies that are able to grow that dividend, generally they're going to outperform over time. And that goes the same for stocks as well. So we look at the higher quality companies. We cover about 150 equity REITs today. And again, all shapes and sizes, all different sectors, as well as the commercial mortgage REITs, not the residential, but we do cover the commercial mortgage REITs. A lot of these are private equity firms or private equity firm backed businesses like Starwood, TPG, KKR, Blackstone, et cetera. And they have commercial mortgage REITs that complement their private equity platforms. And again, these are lenders to different asset class property sectors. We even cover, there's a couple cannabis mortgage REITs now. There's a single family home builder, actually 2 single family home builder mortgage REITs. They provide construction lending for home builders or multifamily home builders. So there's a lot of capital out there today, but again, that's the dividend is really the biggest attraction, to the business. Now, in terms of total returns, because you asked, kind of what drives that, generally, what we try to do, and by the way, I purposely titled my book, The Intelligent REIT Investor, really after the more famous book called The Intelligent Investor, which was, of course, written by Benjamin Graham, Warren Buffett's mentor and coach. And so we're value investors. We like to buy companies, not only REITs, but stocks in general that are trading at a discount to their intrinsic value. And so the way we try to build portfolios or help investors build portfolios, we look at the cheapest companies, but we also look at we want to see quality first. Quality is really the most important. So analyzing the company's balance sheet, its liquidity, its earnings history, its dividend history, its current dividend payout ratio. We spend a lot of time interviewing management teams as well, make sure that they're playing the right game and that that our interests are aligned with their interests. We like to see internally managed REITs, not to say external are bad, but you've got to be careful with conflicts of interest because there are quite a few that we see out there on those externally managed platforms. And again, we evaluate the entire company. We like to build portfolios based on, really the investor's risk profile, because every investor is going to have his or her own types of profile and what they're looking for. Age obviously has a lot to do with it. The younger generation, like my son, for example, is an NFT investor, which I found that hard to believe. But anyway, that's that he's obviously a more speculative, I wouldn't even call investor. He's more speculative. I don't know.
He's a gambler.
Yeah, he's a gambler. Exactly. He is a gambler. And by the way, he won $70,000 during 2021 playing video games online, 70,000. And he got the money in crypto or blockchain. And he's invested about half of that back into, he didn't invest. He put the rest of it back into NFTs and all that. And he's got the other half in some blue chip companies that I've recommended. But at any rate, REITs are great. And, as a developer, I come at this with a different angle because I was a private developer for 25 years. So I can really attest to look, I'm doing private investing too, just as you are and some of your clients. So private's fine. There's that trade-off we have with volatility and liquidity. So if you want to be private, obviously you don't have that volatility, that you don't have Mr. Market telling you what your shares are worth every day when you wake up. But you obviously don't have the liquidity in the private space as you do in the public. So that's the trade-off. It really, I think the answer is probably having a good, healthy combination of both private real estate and public real estate is a good answer.
No, good stuff. You talk about diversification portfolios. Back when I was in grad school, I had my securities licenses and did stocks and bonds and stuff. So really went to Warren Buffett's conference. I had a B share. I couldn't afford the A share of Berkshire, but familiar with Benjamin Graham and all that stuff as well. So good to put that all in the hopper. I think when I think of REITs for manufactured housing, you're obviously a big player because there's a lot of regulatory cost and a lot of underwriting. Some of the benefits you just mentioned, liquidity being one, but also your team, your industry, these people in REITs are being underwritten and being interviewed and such. I've got some money in some limited partnerships, limited LLCs as an LP, and sometimes I'm pretty underwhelmed with the level of reporting and transparency, and certainly the lack of liquidity. It's like, I want my money back. No, you can't do that, right? So there's downside. Now, obviously, you're talking 3.5% dividend. Overall yield a little higher, is obviously higher than that. That's not that enticing to a lot of people. Your son is not going to be that jazzed about investing in a REIT, even if it's Sam Zell's REIT, right? So you've got the big players, ELS, you've got Sun, UMH, Flagship, I think, on the Toronto Real Estate Exchange. And so I know I've got some clients like maybe we'll one day be a REIT. Now, what would you say is the minimum kind of assets under management to make becoming a REIT possible and or worthwhile? Like, you got a $30 million portfolio, not going to happen. You got a $100 million portfolio, probably not going to. Is it $1 billion? Is it does it depend on what the asset class it is? I'm curious on that because I feel like in manufactured housing, the REITs that we see have large portfolios of large parks, Class A properties that buy and sell at low cap rates, not a lot of upside left in them. It's long-term stability and cash flow. And relative to other asset classes, I'm biased, but I think they're going to be better. But you're not going to make a 25 IRR. You're not going to make a 15 IRR, and you probably won't hit 10, is what I feel like. What are your thoughts on some of those topics?
Yeah, for sure. So, and I get that question a lot. What size is a good size to go list? And it really comes down to the management team. And the G&A cost. A lot of companies can't internalize their management until they reach a certain size. But obviously, the benefit to being external or internally managed and having that size is being able to improve your cost of capital. So I think one of the main advantages we see today in the publicly listed side is nobody can. There's a few, but most private companies today cannot compete with the cost of capital that these public REITs have. It's not even close. And especially these companies that have investment grade ratings. And so like the companies that we in the manufactured housing space, of course, Equity Lifestyle, ELS, and Sun Communities, both of those companies have extremely strong balance sheets, and they have benefited from this surge in capital flowing into the space. And this is like, manufactured housing is like the safety zone right now, just given all of the, COVID shift and people, wanting to live outdoors, move to the South. And of course, there's a lot of communities now in the sun states, really, all across the country. And so all of that capital is really moving there to that. And of course, a lot of this, I'm sure you talk about this a lot, but a lot of the value of owning manufactured housing is, of course, you basically, it's a ground lease, kind of a super ground lease for a quarter of an acre. And it's certainly it's affordable. You have to have, housing is important. You have to have roof and shelter, and you got to pay that ground rent, and so just that whole supply and demand is really driving the capital. So the equity cost, so we talk about the weighted average cost of capital, the equity cost and the debt cost for especially these larger cap companies. Equity Lifestyle's got a market cap of over 14 billion, and Sun Communities has a market cap of over 21 billion. Now, a smaller one, of course, UMH is about 1.2 billion. All of those are internally managed. Now, when you get to these smaller companies, you've got it's just harder to kind of cover that G&A cost. A lot of these companies, they may only have one employee, and then they may have an external advisor that kind of oversees all the ancillary costs, legal costs, marketing costs, all that stuff to run the company. So it really depends. I think the magic number is about $1 billion, but I've seen quite a few companies successful at listing at say 400 million or 500 million. And it depends on the complexity of the business model. And net lease REIT, it'd be really simple. You could probably go out and list that one at 100 million because there's you just collect rent checks. There's you don't have to deal with what I call the 3 T's: the toilets, the trash, and the taxes. And so that's why we like net lease, by the way. That's what really my preferred asset class. I was a net lease developer for 20 years, built for companies like Advance Auto, O'Reilly, Walgreens, CVS, Walmart, all that stuff. So that's a great business to be in, just collecting those rent checks. It's we call swan investing, sleep well at night. But I will say this manufactured housing, I've warmed up to it. I would love to own some myself on the private side. They're too expensive. I mean, I just touched on these names I just mentioned. I mean, the valuations for Equity Lifestyle and Sun Communities right now in 2021, of course, we had a huge recovery across all property sectors, but Equity Lifestyle generated 41% returns in 21, and UMH just absolutely crushed it. They did 91% returns. I know the Landy family really well, and of course Sam, who runs UMH, but they just crushed it, and they've been able to really improve their cost of capital tremendously, especially on the debt side. Same thing, Sun Communities up about 41%. Now, we had a sell-off this year, and we're still, although we've had for example, Equity Lifestyle's down around 10%. All the those 3 listed companies in the U.S. are down about 10% roughly, but still they're very expensive from a multiple perspective, from a dividend perspective. They're still pretty pricey today. But back to your point, I know I drifted a little bit here, but in terms of like listing, I think that's probably the appropriate size. But it really doesn't matter. I mean, I think the main thing is if the company's externally managed I was going to tell you these dividend yields real quick, but in terms of internal management, it really depends on to make sure that there's an alignment of interest with the shareholders, and there aren't conflicts. They aren't running competing businesses and so forth. The dividend yields, by the way, for Equity Lifestyle right now is 1.9%, sub 2, Sun Community sub 2, and UMH is 3.5%. UMH has a little more leverage. They don't have the quite cost of capital, but I really like what UMH has done with their expansion model. And again, I think the Landys have done a great job with that.
Oh, that's good stuff. And I've followed a lot of those guys as well, met some of those folks. And when you talk about cost of capital, I mean, from an equity standpoint, but also, with the public shareholders, they can get people who the average Joe doesn't have the same opportunity in private placement randoms and things of that kind of nature, some of the private equity stuff. So they have a lower yield expectation, but then also they get to couple that with the debt. I was talking with one of the REITs and they were saying, yeah, we just closed a loan, 30-year life insurance debt, 2% and change, 30-year fixed rate, 30-year ammo. Just like, what? I can't get anything with a 2 handle now, and not even a 3 handle, and certainly not with a 30-year term. If I get 10-year or 12-year term with 5 years IO, I'm pretty jazzed. And these guys are like, no, it's 30. Like, it's 30 only. Like, okay, well, that's why. And I thought, because I asked them, I said, how can you pay a 4 cap and make any money? And there's no upside. Like, I can pay a 0. I told you about before this call, I had a deal. I paid a 0 cap. It was negative NOI, right? But I had 20% occupancy, so I had the opportunity to increase the asset value and turn it into a 15 cap. But if I'm buying the type of Class A plus property like these REITs are buying a lot of times, it's hard to improve. And how do you pay 4 cap? You're making, what's your yield? And the answer is there: cost of capital, debt and equity, and then obviously long-term growth, operational efficiencies, if possible, things like that.
Yeah. And again, I think it just, what I like about this space is going back to that, underlying ground lease. There's a company we started covering for, I think it was about a year ago, maybe a year and a half ago. They're older than that, but we picked up coverage called iStar and Safehold. So iStar is a commercial lender. They've been around a long time, but they started a division called Safehold, which is a ground lease company. And Jay Sugarman's the CEO. He's done a fabulous job with this business. He's really, kind of the first mover advantage. Of course, everybody's known about ground leases for years and years, but it's now becoming more of I would call it an institutional, asset class, and just buying that underlying ground lease. And, we really like that sector. Again, that's a new space that wasn't even covered, available for public investors. And now you're seeing a lot of these equity REITs now, like Agree Realty, for example, where they're a net lease landlord. They're buying ground leases now and allocating a lot of capital, because that is the safest part of that whole capital stack, obviously, is having that land. But another one that just came up, I had to tell you about this. I was at dinner. I've got an office down in Florida in West Palm Beach, and I was down last week having dinner with a friend of mine who's his name's Gary. Gary was the former CEO of Cyrus One. They're an equity REIT that just was a data center REIT, equity REIT that just was sold. And Gary he was telling me the story. He and his wife were going to go to Europe in 2020, and then COVID hit. They canceled their plans. And in fact, Gary was on my podcast, the Ground Up podcast. And so Gary said, hey, I took a year off. I didn't go to Europe, and I rented an RV with my wife. And he said, I traveled across the country, and he said, I had this great idea about halfway through. He lives in Dallas, but he's got a place in Florida, I think out in the mountains too. And anyway, he was traveling across the country, and he said, you know what? I'd like to create a REIT that's just RV storage. And he's done just that. He just got a sizable round of capital from Center Square, I think Center Point, forget the name. And now he's putting his team back together. And he's going to be, he's not listed yet. He's just got right now some, private equity money, but he's going to roll this out. And that there's a brand new sector that, property sector I never thought about, which I really would love. I cannot wait to have that, pick up coverage on that company. I wish I could invest in it today. It's an amazing business. He's going to take technology to this. As you know, there's so much technology now, I'm sure even in your sector, in terms of maybe collecting rent. We actually cover prop tech now. It's really fascinating. All the innovation that we're seeing in technology. And if you think about it, actually Extra Space was a prop tech company 10 years ago. We didn't call it that, but basically we ripped up the yellow pages and we started utilizing these phones, to lease properties up and coordinate, customer service things. So Gary's going to take his technology background together with this RV storage model. He's going to scale this across the U.S. He's going to become kind of the Marriott of RV storage. So you pull in there with your storage, and you've already got your app. You've already selected the beer that's going to be there for whatever you got. I mean, that's telling me it's fascinating.
That's ahead of manufactured housing. I'll assure you that. We've got some technology in our space, but I do think self storage is higher and RV is higher with better marketing, better branding, dynamic pricing, apps, all that stuff. Where you don't see that as much in the manufactured housing space, but we're kind of our own niche asset. I think we got a lot of the core fundamentals of real estate that are going to be superior than other asset classes. I mean, I'm pretty biased, but I think that's the case. But yeah, I mean, there's other asset classes too. I think that sounds like an exciting REIT. I just had for our fund, we interviewed with a pension fund to try to get their capital because they have a low cost of capital, right? And massive amounts of capital. And they interviewed, I haven't heard back yet, so hopefully it goes well, but they interviewed about a half a dozen MHP guys. And then they told us who else they're interviewing about 10 people. They said they're doing RV, storage, marinas, which made some sense because Sun owns a bunch of marinas in addition to manufactured housing, and then helicopter leases, which I never even thought about that. Like, helicopter lease. I'm like, okay, maybe I should go do that next. But no, that sounds like a high barrier to entry. But that's the new thing, right? I mean, I talked to a client of mine yesterday who he's launching a fund and manufactured housing. And he said he's got a bunch of wealthy contacts. And they're like, with one family office, like, we get pitched 1,000 multifamily funds a year. And I don't like any of them. They're all the same. They're all, they're all overpriced. Their assumptions are all blah, blah, blah. But he's like, ooh, tell me more about these trailers. He's like, they're not trailers. They're manufactured housing. But he's like, whatever. Tell me more about the sticky tenant base. Tell me more about the supply demand gap and tell me about the entitlement challenge and all these other things. Like, okay, I got your ear. So that's part of it, right? Is find something different. You've been able to do that. Set yourself apart on the analyst and author side as a thought leader in a niche space, and that's what our industry tries to do is be different than 32 unit apartment complexes. Be different. Triple
I totally agree, and I think you've done a great job with this. By the way, I tell all of my kids. My oldest daughter, she works at CNBC. Her name's Lauren Thomas. So you Google her. If you don't know her, because a lot of people know her when I mention her name. But anyway, she went to business journalism school. I actually did what I should have done is go to business, get a degree in business and journalism. I missed the journalism part, but she's at CNBC and she has a niche. She covers retail, and that's in her sector, and she's become an expert in her sector and done a great job there. So I think that's what I tell all my kids. Just find your passion first. That's, as you're obviously passionate about what you do, as I am as well. And then you find those niches, find those areas which you can really become the number one person in that, in that sector. Speaking of niches, I was going to tell you one other thing that was really fascinating. We covered the cannabis, I mentioned the cannabis. And again, I never thought about cannabis. There's been a lot of volatility around cannabis. Obviously, and the REITs have actually filled a huge void in the market because the big banks, Bank of America, and these federal banks can't lend to the space. So there's some laws that have been discussed and tossed around, and it's highly political. Actually, I interviewed yesterday a CEO of a private cannabis fund, and he indicated he didn't think the Biden administration were going to see any changes. So it'll be a while, but this sector has been extremely volatile. But what's interesting for it, again, in terms of, kind of the cap rates and the comparison of, say, cannabis real estate to manufactured housing, it's the exact opposite. These cap rates are like, they start at 12% and they go as high to 20%. It's unbelievable, especially when you get into the greenhouses and some of those way out in the middle of nowhere locations. But, it's really interesting to see. And so, companies like IIPR, which they were the first innovative industrial, They were the first mover of the cannabis sector. They've got, we're forecasting and analysts are forecasting returns of growth of about 40% this year, 40% earnings growth, which means the dividend's going to be, probably 35%. It's just incredible, again, to see. We actually own that one and a couple others out there as well. But, it's definitely a lot of diversification and opportunities. But again, back to your sector, manufactured housing is really the way to go. I would like to be on the private side again. I wish I would have bought ELS or SUI early on, or even UMH. We did own UMH in the past, but it's just the valuations just don't make any sense right now. So I think the private money is probably the way to go as far as I'm concerned.
Yeah, I think you find a good operator, definitely from a yield perspective. Private's definitely the way to go. And as far as the cannabis, I think I'm pushing some business that way because I just evicted 3 trailers full of greenhouses. So
wow.
I'm sending more to the other business. But
well, we also cover the prison sector too, by the way.
Oh, good. I was in the field this morning. We got a park in Central Illinois, and the prison is like a mile away. And I was like, we need to get some of the guards as tenants. We need to get them to move in because there's good jobs and good stable employment base, and hey, that'll keep if the guy next door works at the prison, you're probably not going to be selling drugs. So yeah. In Illinois, marijuana is legal. So it's like I can't really say no. But in general, I prefer for it to not be in the property. But,
sure.
Well, this is great stuff, Brad. I really appreciate your perspective. What any other tips or concepts before we go, and also let us know where we can find you.
Sure. Well, first off, I would I remind all my subscribers and listeners, REITs everybody should have REITs in their portfolio, especially as you're in retirement or moving to retirement. This is a very stable asset class, especially when you pick the companies that are going to increase their dividends and grow their dividends. Our core portfolio has returned about 22% annually, called the durable income portfolio. So we focus on those very stable and predictable dividend stocks. We've got about 40 companies in the portfolio. We've generated over 22% annual return since 2013. So that gives you an idea is how that sector's really performed. In terms of allocation, we think that investors should have around 10 to maybe even 20%, possibly higher, depending on the risk profile of the investor. But we think certainly 10% is the low end, 20% probably the high end. Again, depending on investor. And again, REITs offer this liquidity that the private space doesn't have, and very predictable incomes and very stable and predictable total returns. Now, where you can reach me is I've got really 2 websites. One is real simple, bradtom.com. My name is Brad Thomas. I just shorten it to TOM, bradtom.com. And then Wide Moat Investors. Again, Warren Buffett will tell you what a wide moat is. Wide Moat Research is our company.com, widemoatresearch.com. And again, I appreciate you letting me go on for your show. I look forward to having you on mine as well.
All right. Sounds good, Brad. I appreciate it.
Take care.
You've been listening to the Mobile Home Park Lawyer Podcast with Ferd Neiman. Ready to learn more? Go to www.themobilehomelawyer.com for free resources and materials to help you succeed. If you love the podcast, go to Apple Podcasts, give us your review, and subscribe today. Thank you for listening. Neither the Supreme Court of Missouri nor the Missouri Bar reviews nor approves certifying organizations or specialist designations. The choice of a lawyer is an important decision and should not be based solely upon advertisements.